Folks, let me tell you something I've learned after nearly a century of watching markets rise, fall, and get themselves into all sorts of trouble. Human nature doesn't change very much. People get greedy at the same time, they get fearful at the same time, and they repeat the same mistakes with astonishing confidence. And when they repeat those mistakes loudly enough and often enough, they eventually convince themselves something brand new is happening, something the world has never seen before, when in fact it's the same old pattern wearing a fresh coat of paint. And that's the situation we're walking right into today. What we're living through right now, and what the whole world is feeling whether they realize it or not, is a setup that has only appeared a couple of times in modern financial history. The late 1922s had it. The mid-2000s had it. Excessive optimism, extraordinary valuations, and then leverage piled on top of leverage as if the laws of arithmetic had quietly retired. And if you look at the facts, not the headlines, not what your favorite analyst says, but the facts, you'll see that we are right back there again. Same gravity, same physics, same behavior. The stage may look modern, but the script is familiar, and it never ends differently just because we wish it would. Now, I'm not here to scare anyone. I don't get anything out of fear-mongering. I'm far too old and far too Midwestern for that. But I do believe in pattern recognition, especially when the patterns stretch across a century of data. Whenever you see extreme asset valuations across the board, stocks, real estate, bonds, even things that aren't supposed to be speculative at all, combined with the idea that risk has been abolished by some new mechanism, like the Federal Reserve becoming an all-powerful guardian angel, you should take a deep breath and sit up a little straighter, because that's when the cracks start forming under your feet, even though everything looks fine on the surface. And that's where we are at the start of 2025. Take housing, for example. When the median American home costs $420,000 and the median household makes $75,000, that's a ratio you simply can't defend with long-term economic fundamentals. Not when the historical norm is something closer to 3 to 1. You don't need a PhD in anything to understand that people can't afford something forever if the price grows, but their incomes don't. It only lasts as long as cheap debt papers over the gap. And when that cheap debt disappears, the arithmetic takes over again. Houses don't crash because people stop liking houses. They crash because the financing that inflated them can't sustain the burden anymore. And it's not just housing. Corporate debt, government debt, consumer debt, you look anywhere and it's a record breaker. I've always said that debt itself isn't the problem. Debt can be a useful tool. But when you borrow because you think the future can only get better and never worse, well, that's when you're building a house out of straw and hoping the wind doesn't pick up. Right now, non-financial corporate debt is around $13.5 trillion, roughly 72% of GDP. That's not a gentle incline. That's a cliff. Government debt is $36 trillion and rising faster than North Dakota corn in July. Consumers have $17 trillion of their own. Add everything together and you have over $90 trillion in debt on a $28 trillion economy. You don't need to be a mathematician to see the mismatch. Debt has consequences, especially debt taken on under the assumption that interest rates would stay near zero for the rest of time. And that brings me to the Federal Reserve, an institution I respect but don't revere as an all-powerful magician. For 15 years, they've kept money so cheap that markets got used to behaving like a teenager with unlimited text messages. Every dip became a buying opportunity because the Fed was there to catch you. QE1, QE2, QE3. COVID stimulus, $8 trillion created in a little over a decade. And when you pump that much liquidity into the system, it doesn't politely wait in the checking accounts. It flows into assets, driving them higher. And it teaches everyone from hedge funds to your cousin who bought crypto at the peak that the Fed will always open the umbrella when the rain starts. But life doesn't work that way, and neither do central banks. They ran out of dry powder. When inflation exploded in 2021 and 2022, the Fed found itself in the awkward position of having to clean up the very mess its policies had helped create. So it raised interest rates from 0 to 5.5% at the fastest pace in 4 decades. And while that was the right thing to do for long-term stability, it also meant every bit of debt issued during the zero-rate era was now a ticking time bomb. Corporate bonds issued at 3% now had to be refinanced at 7% or 8%. Mortgages written at 3% are suddenly 7%. And the important part isn't that these numbers look inconvenient. The important part is that the entire economic structure was built on the assumption those old numbers would last forever. When rates go up this quickly, they don't just slow the economy, they force a reckoning. And that's exactly where we are now. The Fed can't cut dramatically without reigniting inflation. It can't raise without crushing debt holders. In poker terms, they're in the middle seat with a mediocre hand and no good options. Now, what does this remind me of? Well, a lot of people like to think the Great Depression was a one-of-a-kind event and that the 2008 crisis was a fluke caused by some bad actors and sloppy lending. But if you step back, you'll see the mechanics were almost identical. In the late 1920s, stocks quadrupled in 5 years. In the early 2000s, houses doubled in 6 years. Everyone believed in a new era. In 1929, we got the famous line about a permanently high plateau. In 2006, we got housing prices never fall nationally. And today we hear the Fed won't let the market crash. Well, the trouble with believing something can't happen is that you stop preparing for when it inevitably does. And then you get a trigger. In 1929, it was margin debt unwinding. In 2008, it was subprime mortgages. In 2026, or whenever the next big break comes, it could be any number of things. Commercial real estate collapsing, for instance. I don't care how fancy your office building is. If half the desks are empty because people prefer working from home, that building isn't worth the debt backing it. And when those debts come due, refinancing at double the interest rate, you're going to see defaults. Not because people are incompetent, but because the math doesn't allow any other outcome. And when commercial real estate goes bad, it goes straight through regional banks because they hold a big chunk of those loans. Once regional banks wobble, confidence follows them right out the door. Another trigger? Corporate bankruptcies. A Fortune 500 company defaulting on its bonds would be a sobering moment. Credit markets freeze fast when lenders lose confidence. And the global nature of debt today means that trouble in one country, Turkey, Argentina, or any heavily indebted emerging market can cause dominoes to fall on the other side of the world. Contagion used to be a slow-moving virus. Today it spreads at the speed of a tweet. And still another trigger: geopolitics. A war, a pandemic resurgence, a contested election. You don't need an economic cause to start a financial panic. You only need an emotional one. Fear is an equal opportunity catalyst. But no matter what the trigger is, the mechanism is always the same. Markets take an initial fall, 10 to 15%, and most people interpret it as a buying opportunity. They did in 1929. They did in 2008. They will again. Professional strategists will quote historical averages. Remind everyone that markets typically rebound after sharp declines and point to the strength of the consumer. And for a while, the market might even stabilize. That's what I call the false spring. The first warm day after winter doesn't mean it's time to plant corn. It just tricks you into thinking it is. After that comes the cascade, and the cascade is always about leverage, not emotions. When people borrow 50 cents for every dollar in stocks, or when companies issue debt, assuming cash flow will always be strong, the moment prices fall, they don't get to choose whether they sell. They must sell. Forced liquidation is the most powerful force in financial markets. It pushes prices down regardless of value, regardless of fundamentals, regardless of the human stories behind the numbers. It's like gravity, steady, indifferent, and relentless. When that cascade begins, credit freezes. When credit freezes, businesses struggle to refinance. When businesses can't refinance, layoffs begin. And layoffs create fear, which reduces spending, which reduces revenue, which leads to more layoffs. At that point, you're no longer dealing with markets, you're dealing with the real economy. And once the real economy starts spiraling, recovery becomes a long, painful process. Some people say, but Warren, won't the government just print money again? And I say, they will, but it won't be as easy this time. In 2008, the government had room to spend. In 2020, it had room to spend. But when your debt is already 120% of GDP, and interest payments alone are nearly $1 trillion a year, the room for maneuver narrows. Stimulus will come, no politician can resist it, but the long-term consequences will be heavier and the recovery slower. That's just reality. And who gets hurt most when a crash comes? It's not complicated. The middle class, people with 401ks who think long-term investing protects them from valuation risk. Homeowners who bought recently with large mortgages. Small business owners who depend on consumer spending. Folks who played by the rules, saved what they could, invested in what they were told was safe, and suddenly find themselves facing losses they never imagined. That's who pays. They paid in 1929. They paid in 2008. And they'll pay again if this pattern plays out the way it has before. But it's also true, and this part is uncomfortable to talk about, that crashes create enormous opportunities, not for the average investor, unfortunately, but for those sitting on cash, patience, and emotional stability. In 2008, I was able to make deals with Goldman Sachs and Bank of America because I had the liquidity to act when others were afraid. John Paulson made billions shorting subprime mortgages because he saw the structure for what it was. In 1929, the Kennedy family built its fortune by betting against the bubble. Every crash transfers wealth. It doesn't disappear. It moves from the leverage to the liquid, from the fearful to the patient, from the optimistic to the prepared. If the next big decline happens, as the pattern suggests, the same transfer will occur. Now, I'm not telling you to panic. I'm telling you to prepare. And preparation is mostly psychological. You have to understand that markets don't care about your preferences. They don't rise because you want them to rise. They don't fall because you think they should fall. They follow the forces of mathematics, leverage, and human behavior. And those forces are lining up today in a very familiar way. If you know the pattern, you can survive it. You may even benefit from it, but only if you're honest about where we are right now and where we might be heading. Now, if you're still with me, let me carry the thought further, because once you understand how these cycles unfold, the rest becomes a matter of staying rational when the world around you isn't. And trust me, I've lived long enough to see that rationality is in short supply when markets begin to crack. People who seemed calm and collected 3 months prior suddenly act like deer in headlights. And once fear enters the bloodstream of the market, it spreads through the whole financial system faster than you'd believe. When a cascade really hits, the selling isn't thoughtful. It isn't strategic. It's mechanical. Margin calls go out. Institutions hit redemption limits. Algorithms seize on volatility and amplify it. Prices gap down, not because a company suddenly lost its ability to make money, but because there are simply no buyers left at the previous price. Liquidity dries up like a Kansas pond in August. I've seen it happen more times than I can count, and it always feels the same. That's why I often say, if you want to see how brave you really are, watch how you behave when your stocks are falling 5% a day and the news tells you the world is ending. That's when you find out who you are. And when the real panic arrives, it doesn't just take down speculators. It takes down regular folks. The middle class, the backbone of the American economy, carries the brunt of it. Think back to the Great Depression. Families who felt wealthy in the summer of 1929 were standing in soup lines by 1933. Or consider 2008. Homeowners who bought at peak prices saw their equity vanish almost overnight. Small business owners, whose livelihoods depended on steady customer traffic, saw revenue fall off a cliff. That's the part of this story I always focus on, the human cost. When the middle class gets hit hard enough, the country changes. Politics changes. Society changes. And those changes aren't always pleasant. What makes the coming years especially tricky, if the pattern holds, is that the middle class today is more fragile than it was 20 or 30 years ago. People are stretched thinner. Savings are lower. Debt is higher. Housing is less affordable. Healthcare costs more. And if you take that kind of vulnerability and combine it with a major financial shock, you can create conditions that reshape a generation's attitudes toward markets, toward government, toward capitalism itself. And I worry about that. I really do. I love this country. I believe in the American system. But it's held together by trust. Trust that if you work hard and play by the rules, you can build a comfortable life. If enough people lose faith in that promise, the system weakens. We saw hints of it after 2008. Occupy Wall Street, the Tea Party, the polarization that has only grown since then. That wasn't random. It was a direct predictable response to economic insecurity. Now imagine something bigger. Imagine a wealth wipeout larger than 2008 and more globally synchronized than 1929. Imagine the social reaction. That's why understanding this pattern is more than a financial exercise. It's a civic one. It's about stability, opportunity, and the long-term health of the country. But let me come back to markets, because markets are where the consequences begin to take shape. After the cascade phase comes the bottom, what I call the moment of maximum panic. In the past, it looked like July 1932 or March 2009. In the future, it might be late 2027 or early 2028. It's the point where people sell not because they want to, but because they can't bear to hold anymore. They capitulate. And capitulation is the closest thing to capitulation in life. You give up, emotionally and financially. That's when value investors suddenly feel very lonely. But that's also when the greatest opportunities of your lifetime appear. Not when stocks fall 10%, not when the media says buy the dip, but when no one wants to touch stocks with a 10-foot pole. At that moment, cash is a superpower. And people often misunderstand why I like cash when markets get frothy. It's not because I can predict the exact top. I can't. Nobody can. It's because cash gives you optionality. It keeps you from being forced into selling at the wrong time. It lets you buy when everyone else is stuck on the sidelines. It protects you from your own impulses. That's why I've always said cash isn't trash. It's a call option with no expiration date. And in a major crash, it becomes the most valuable asset you can hold. Now, who actually benefits in a crash? Well, history tells you plainly. Those who are liquid, those who are patient, those who avoid leverage, and those who prepare mentally before the storm hits. The names change across decades, but the pattern doesn't. In 1929, it was Kennedy. In 2008, it was Paulson, Burry, and a handful of distressed debt investors who understood the math. In 2026 or 2027, if the pattern repeats, it will be investors who kept their powder dry while everyone else was celebrating the new era, or large private equity firms sitting on mountains of dry powder, or gold holders who act as a counterweight to monetary expansion. And yes, investors like us at Berkshire who hold significant cash reserves will have opportunities. We don't root for crisis, but we recognize that crisis creates prices we haven't seen in decades. And when markets offer you wonderful companies at half price, you don't need brilliance to succeed, you just need courage. But courage is rare, and that's the whole point. After the panic bottom comes the recovery. But let me tell you something important. Recoveries differ remarkably depending on the starting conditions. The recovery after 1933 took decades because the system had no safety nets. The recovery after 2008 was relatively quick because the government had tools and fiscal capacity to act aggressively. But the next recovery, if the debt picture stays as it is, won't be as easy. When your government debt is 120% of GDP and rising fast, your ability to spend your way out of a recession becomes constrained. You either raise taxes, cut spending, or allow inflation to help you. None of those choices are pleasant. All of them have political consequences. This is why I expect the eventual recovery whenever it begins to be slow, not a straight V-shaped bounce. More like a long, uneven path upward, and stock prices might not revisit their 2025 highs until 2032 or even later. That's not pessimism, it's math. It's history. It's understanding what happens when an economy already burdened with high debt must absorb another shock. Now let's talk about the timeline. No one can give you dates with certainty, only fools do that, but patterns give you probabilities. Early 2025 is where we stand. All-time highs, enormous leverage, and widespread confidence that the Fed will save us. Mid-2025 to early 2026 is when a trigger could arrive. That's when commercial real estate maturities pile up. That's when corporate refinancing collides with higher rates. That's when geopolitical tensions could flare. If something big happens in that window, it fits the pattern of both 1929 and 2008. Then you get a 10-15% drop. Then you get a false recovery. Then the problems spread quietly while the market pretends everything is fine. Then, late 2026 to mid-2027, the cascade arrives. Leverage unwinds, credit tightens, investors panic. That's when portfolios built on optimism rather than realism fall apart. And then, late 2027 or early 2028, you get the bottom. The moment most investors swear off stocks forever. The moment newspapers publish headlines about the death of equities. I've seen those headlines printed more than once in my lifetime, and each time they marked the beginning, not the end, of tremendous long-term opportunity. Then comes the rebuilding. Stimulus, rate cuts, political compromises, new leaders, a society chastened. Markets eventually recover, but the world is different afterward, and that difference lasts for years. Now, let me shift from the pattern itself to what a rational person can do about it. And I want to emphasize this. Nothing I say should be taken as specific financial advice. I'm not your advisor. I'm not telling you what to buy or sell. I'm telling you how I think about these events after a lifetime of observing them. First, reduce blind exposure. If someone is 100% in stocks at all times because they heard that stocks always go up, they're not investing, they're parroting. Markets do rise over the long run, but they don't rise in a straight line, and they don't rise from absurd valuations without correction. There's nothing wrong with holding cash or treasury bills in an overheated market. Missing out on the last 10% of a mania is far better than riding the first 50% of a crash. Second, hold some gold or inflation-resistant assets. I've never been a gold bug, but I respect it. Gold can't be printed. And when governments need to stimulate aggressively, currencies weaken. Gold's role isn't to make you rich, it's to keep you whole. Third, prepare your shopping list. Long before the crash, you want to know which companies you'd be thrilled to own at half price. Apple, Microsoft, Johnson & Johnson, Visa. Companies with strong brands, durable moats, low debt, and management teams you trust. When fear peaks, you won't be thinking clearly enough to research them. That work must be done today, calmly, rationally. Fourth, protect your income. Crashes hurt most when people lose their jobs. So focus on being valuable, adaptable, and indispensable in your workplace. Reduce personal debt. Build an emergency fund. A job is the best financial asset most people have. Protect it like it matters, because it does. Fifth, understand the psychology. Buying when others are terrified is not an act of intelligence, it's an act of temperament. Anyone can read financial statements, but not everyone can stay calm when their portfolio is bleeding. If you can strengthen your psychological muscles today, you'll make better decisions tomorrow. Sixth, watch the early signs. Commercial real estate defaults, high-yield bond spreads, regional bank stock performance. These indicators will tell you when the foundation is cracking, and markets always crack before the public notices. Now, I want to close with a thought that has stayed with me for decades. Crashes don't destroy wealth, they transfer it. They always have, they always will. From the unprepared to the prepared, from the leveraged to the liquid, from those who hope to those who act. If there's one lesson from the Great Depression, and from 2008, and from every crisis in between, is that preparation is not pessimism. Preparation is prudence. Hope is not a strategy. And ignoring patterns does not protect you from them. 2025 looks like 1,928 and like 2007 inches, all the ways that matter. Extreme valuations, extreme leverage, extreme confidence, and a belief that safety nets are infallible. Maybe the Fed engineers a soft landing. It'd be delighted if they do. But twice before, when these same conditions aligned, we got historic crashes. And if the same pattern plays out again, the consequences will be profound for investors, for families, for small businesses, for society. The pattern doesn't guarantee a crash, but it does warn you, and history is a loud, persistent teacher. It repeats its lessons until we learn them or pay for ignoring them. You have a choice. Pretend this time is different, or prepare as if the pattern might be right. One choice leads to panic. The other leads to opportunity. I know which one I'd choose, and I hope you choose it too.